Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. As many of you will know, I'm into my stats, and I was looking at the stats for this podcast show, and I just discovered we have crossed the 100,000 download mark. In fact, we have had 110,000 downloads of the show over the past year. So a big thank you to all our listeners. It's gratifying that we have such a dedicated audience. I also took a look at the most read pieces on the Macro Hive site so far this year, and the most read piece has been one of our earlier Grey Swan pieces for 2021, which was on UK to outperform in 2021, which has turned out to be quite prescient. The second most read piece was a piece on how higher US yields are good for equities. And the third most read piece was a piece called The Real Meaning of the Reddit Rebellion. They're all great reads and have stood the test of time. And if you sign up at macrohive.com to become a member, you'll be able to read these pieces as well as our entire archive. And you'll have access to our Slack room, which contains a healthy discussion on markets, which is quite different from what you get on Twitter. Your first month is free, and then it's only the cost of a few weekly cappuccinos. It's well worth it, and many call Macro Hive the hidden gem for investors. So once again, sign up at macrohive.com. Now on to this episode's guest. I have David Riley. David is partner and chief investment strategist of BlueBay Asset Management, a $70 billion fixed income fund. Before BlueBay, David was global head of Fitch's Sovereign and Supranational Group, responsible for more than 130 ratings of the world's largest fixed income issuers. And before Fitch, David was at the UK Treasury, where he advised on international economic and debt issues, including representing the UK at international debt restructuring negotiations at the Paris Club of Official Creditors. Now on to my conversation with David. So welcome, David, to the podcast show. It's great to have you on.
Well, thanks very much indeed, Bilal, for the invitation. I'm really looking forward to it.
What I always like to ask my guests first is their origin story. So what did you study at university? And then how did you end up where you are now as CIO of BlueBay, the asset management firm?
Yeah, it's a long and winding road, but I actually spent the first 10 years of my working life in the public sector, in different parts of the public sector, including in the civil service as an economic policy advisor. I was working at HM Treasury, and that was great because I learned a lot in terms of the interaction and working with other teams within a team of economists, working with policymakers. I mean, I was much more of a sort of bag carrier, but get to sit in on meetings with ministers and UK G7 Sherpa when they've got a conference call with other G7 representatives and represent the UK at the Paris Club of Official Creditors when there was the restructuring of Russia's Soviet era debts. So, as I say, first 10 years, very much working in public policy. And that reflected really the interest that I have and still have from my, student days, distant though they are now, in what I would describe as kind of political economy, really. I've trained as an economist, but it's kind of political economy. I'm interested in politics and economics as a way of understanding the constraints on politicians and policymakers, and then, how the policymaking process sort of, works. And then I went from Treasury to ultimately become head of global sovereign credit ratings at Fitch ratings agency. And, that included managing the global team through the Eurozone crisis. And, that was, extraordinarily interesting and challenging time. You sort of get a greater appreciation and understanding of how you can get these kind of multiple equilibria, whereby during that Eurozone sovereign debt crisis, countries and governments were solvent and liquid, but only solvent and liquid if markets believed they were solvent and liquid. And if they didn't, then in fact they were going to go bust. So, interacting with policymakers through that time, including less positively being pursued by prosecutors in particular European country, because they didn't like the fact that their credit rating had been downgraded.
Okay, it gets very personal.
It can get personal, yes. However much you try to avoid that, and of course things around the US rating. And then that also in terms of the interaction with investors as well. And then, BlueBay asset management, asked whether I'd be interested in this role as chief investment strategist. And I thought, what could be better than to continue to, look at the issues and topics and around credit, around debt, around macroeconomics, and get paid for that, get paid to think about these big issues. Of course, when you're on the investment side, you also have to come up with some actionable and successful investment ideas, which is the tough part of the job. But that's really my journey, is really from being interested in political economy, public policy, and really that just by a kind of process of natural progression brought me into sort of the financial industry and where I am now at BlueBay.
Yeah, no, it's a really quite good and nice sort of varied background. And just for our audience, what does BlueBay focus on? What's its investment kind of focus?
Sure. So BlueBay is a specialist active manager of fixed income and credit, including emerging market debt. So we manage about $72 billion of fixed income credit. So that would be from high yield bonds, leveraged loans, collateralized loan obligations, through to investment grade corporate credit, core fixed income, sovereigns, and the various blends of emerging market debt, so emerging market local currency debt, sovereign and corporate so-called hard currency debt, as well as strategies like convertible bonds and multi-asset credit strategies where the end asset owner gives us discretion, not only obviously as an active manager in terms of security selection, but also in terms of tactical asset allocation around a strategic allocation to credit. So, which I'm more actively involved in terms of some of the portfolios and strategies. So the relative value between, say, high yield bonds and leverage loans at different parts of the cycle, or whether we should be relatively increase exposure, say, to emerging market debt relative to developed market credit.
Okay, yep, understood. One thing I wanted to pick up on is, you obviously worked at the Treasury and then also at Fitch, and you sort of mentioned the point about debt sustainability. And this is a big issue today where countries are issuing huge amounts of debt, yet interest rates are quite low. And you kind of hear the bond vigilantes or the fiscal hawks saying it's unsustainable. If you look at a chart of debt to GDP of any country pretty much in the world these days, and it goes back 10, 50 years or 100 years, the line's off the chart. But, yields are low. I mean, there's no crisis. How do you kind of look at debt sustainability for like a rich developed country?
Yeah, I mean, I think it's been a really interesting evolution. And I have to say it's one which I've also sort of undergone to some degree. I remember one of my experiences, actually, as an aside, when I was at Treasury, I was attending a meeting with more senior people than myself from other departments, and they sort of asked this question about whether they could go ahead with this particular project. And I said no. Then I kind of went back to the Treasury offices and went to my boss and said, I said no, and I'm not sure whether I should have done or not. And he said to me, that's absolutely fine. If ever in doubt, say no. And that's the traditional sort of Treasury and Ministry of Finance more generally sort of ethos, and is one which, also carried into from a credit rating perspective. I mean, look, I still do think there is ultimately some intertemporal budget constraint on governments, that there is some kind of limit to how long one can continue to sort of borrow and the level of debt that is built up. But I think the transformation or the transition is become much more nuanced, and it's been reflected more importantly in the way that I think central banks are thinking. And, it's an interesting contrast. You look at what the ECB was saying, not only during, but also in the sort of aftermath of the Eurozone's debt crisis, and almost every monetary policy press statement, started with the importance of governments meeting their deficit targets and putting debt to GDP on a sustainable downward path. If you sort of look at the recent ECB statements, they usually kick off with something along the lines of how important it is for sort of coordinated fiscal support for the recovery. And obviously we're seeing that play out as well in the US. And I think part of that transformation or transition in thinking has also come from the fact that debt service costs are so low. So despite, debt to GDP ratios being at or approaching, sort of historically record highs, debt servicing costs have actually been declining. So I think what we've kind of learned is two things. One is that for credible and typically tend to be sort of advanced and, as you say, sort of wealthy or rich countries, then the sort of budget constraint, if you like, is much further away than the sort of Reinhardt and Rogoff 90% of GDP. I don't know where it is, but it's further away than that. And the, debt servicing costs are such that that's, I think probably should be given a greater weight in assessing overall levels of debt sustainability. But, low rates may not stay with us forever. And paradoxically, a lot of people view sort of quantitative easing as bailing out governments, etc. But actually, really what has been going on is that governments have been exchanging or essentially been, borrowing short increasingly because the central bank has been buying long dated government bonds, and the liability they've created to fund that is a short dated floating rate liability, which is reserves that are held by banks at the central bank. So it's actually, if anything, made government finances in many countries somewhat more sensitive to higher rates. And I think, I think a potential kind of policy tension at some point in the future, which is, if we get to the point where central banks think they can and should be, quote, normalizing interest rates, will they come under pressure from governments who will be concerned about the impact that will have in terms of budgeting?
But I guess that interest rate mismatch, so to speak, would sit with the central bank, wouldn't it? I guess they'd be the ones that would bear that cost.
But effectively, it's fiscal, because if you look at the Fed has been making payments into the federal budget because it's essentially been generating a positive carry on its asset portfolio.
Okay, so through the P&L of the central bank, sometimes it's positive, sometimes it's negative. It'll end up going back to the Treasury.
Yeah, I mean, because I do think in that respect, ultimately, it does make some sense to, if you like, consolidate, as actually some countries do. So if you looked at, for example, UK net public sector debt, they actually do net off Bank of England holdings of gilts, but they also then include the reserve liabilities that have been on the other side of that. And it's why, when some sort of suggest, writing off government, which is held by central banks, it doesn't really reduce the public sector liabilities. I mean, they would still have the liabilities. It would create a huge hole in the central bank balance sheet, which ultimately has to be covered by the sovereign, by the government. But it wouldn't actually sort of change the sort of net liability position of the public sector versus the private sector.
Yeah. And if we step back and just look at the sort of the bigger picture for a moment, we've obviously had the onset of the COVID pandemic almost a year ago, just over a year ago now. We had the initial shock. Now we're kind of in the kind of recovery phase of sorts. There's obviously second, third waves going on, but we have a lot of fiscal support, especially in the US. There's a vaccine coming through in many, many sort of countries. How are you kind of looking at the global growth, inflation, the business cycle sort of picture at the moment?
Yeah, so I mean, my views are, and the way that we're broadly speaking positioned is a pro-growth, is a pro-reflation outlook. And, that is based on all of the things which I'm sure will be very familiar to everybody hopefully listening into this podcast. One thing which has been very striking about, and we've kind of touched on this a little bit, I think that the evidence today, not just in terms of, there's obviously forecasts, but if we actually look at even some of the sort of hard data, broadly speaking, I think is consistent with that narrative. But there's certainly lots of uncertainties that still exist. But I am a believer, if you like, in the kind of global recovery, global reflation theme.
Yeah. And do you have a different view regionally? So obviously there's kind of this global story, but then you have Eurozone at the moment, the vaccine rollout's been slower. There's talk of lockdowns. China seems to be less aggressive on the policy side. They seem to be, especially compared to what they did after the global financial crisis. And then there's US kind of zooming ahead with, more and more fiscal stimuli packages. There's every week there seems to be another one. Are you differentiating across regions, or do you think that you don't really need to? It's kind of a global and widespread theme.
Yeah, I think that's a really good observation. And if we look at, for example, consensus growth forecasts back in, November, then, the consensus, which, often is a bit of a lagging indicator, but nonetheless, the kind of consensus growth forecast for 2021 for the US has moved higher by about 3.5 percentage points. I mean, that's a big move in growth expectations. And actually for the Eurozone, it's actually dropped. You've seen revisions downward in 2021 growth forecast by around about 1.5 percentage points. Now, part of that is because actually 2020 wasn't quite as terribly, terribly bad from an economic perspective as originally feared and forecast. But also part of that is precisely as you suggest, which is the ongoing monetary and fiscal response is less decisive than in the US, and the vaccine rollout and sort of persistent sort of restrictions on social activity have been kind of extended through time. And I think that's important because when you get those kind of divergences, I think one part of that kind of global reflation narrative, which this year, so far this year at least, hasn't really played out, is that a weaker dollar. And I think one of the reasons why that hasn't really played out is because we've seen this divergence around growth expectations, and we're back into a little bit of a kind of US growth exceptionalism, higher US rates, and that's supporting US assets but US dollar as well. And that's also spilled over in terms of not only euro dollar exchange rate, but also in terms of emerging market assets, or in particular emerging market currencies and local debt. So the way the divergences, if you like, across countries or regions, it does have a meaningful impact, I think, in terms of how you, as an investor, try to position for the recovery. But I actually think we're probably quite close to peak pessimism on the European outlook. I do actually think it's probably being a little bit overdone, that actually the efficiency of the vaccine distribution in Europe is not so different from that of the US and UK. It's that they've not really had sufficient supply. I think that's going to change pretty significantly over the coming weeks and months. And that in the grand scheme of things, if they're sort of 6 weeks behind or 8 weeks behind the UK and the US, I don't think that's ultimately going to make a sort of huge difference. And on the fiscal side, I think it's less of a headline fiscal support, but we're still getting the short-time working and furlough supporting households, and the EU Recovery Fund, which I think is important, will start to kick in towards the end of the year and into next. So I think one can get a little bit too bearish on the European outlook, but it's certainly the case that right now, I'd have a bias to a stronger dollar. I would have a bias to being sort of short US rates and pretty much sort of neutral in terms of the European rates outlook.
Yeah. And on the dollar strength, I mean, do you think it could continue for the rest of the year? I mean, is this more for short-term phenomena, or do you think, for the next 12 months, you could see continued dollar strength?
Yeah, I mean, I'm an investment strategist, but I do find making calls on the dollar in particular, but sort of, G10 currencies, a particularly difficult part of the financial astrology. I think in the near term, I'm reasonably confident that the direction of travel is for a stronger dollar, because I think we are going to see more evidence more quickly in terms of recovery and reflation. So that will include some pickup inflation. I suspect that we'll see, a renewed drift higher in terms of US rates as well. And so I do think, for the near term, you have that bias towards a stronger dollar. I think longer term, the case for a weaker dollar is that actually the rest of the world, this is not just a US recovery story. The rest of the world is recovering. Obviously, China has already experienced a V-shaped recovery that is going to spill over in terms of, broader recovery in terms of economic activity across emerging markets, and including, and obviously within Europe. And that, maybe to your earlier question, at some point along the line, there is a price to pay for what is going to be widening between fiscal and current account deficits. And so that sort of longer term, we might get into the sort of early 2000s period, or mid 2000, where you had big twin deficits in the US, and that was associated with a sort of dollar bear market.
Yeah, understood. And, one of the things that's been a bit tricky on the investment side has been, we've seen this rise in US yields, as you've mentioned. And the question, keeps coming back, is that good for risk markets or not? Is it good for equities? Is it good for credit? I mean, how do you think about that?
Yeah. So, well, look, it's part of bear steepening of the yield curve is very much part of our kind of playbook coming into, from, the sort of third quarter of last year and coming into this year. So while being, pro-growth, pro-spread risk. So what I mean by that, we're a bias towards more cyclical, lower rated credit. It was the notion that actually we would also see some bear steepening of the curve. And so, seeing higher rates isn't something which I think, is inconsistent with nor should derail a rally in more growth sensitive risk assets more generally. Where historically we've had situations where, higher rates have really moved higher, and treasury yields in particular has really sort of derailed broader financial markets, has been when it's reflected shifts in perceptions around the central banks and the Fed in particular, market perceptions that have become more hawkish, or that they're too hawkish relative to the sort of economic outlook. And, obviously the taper tantrum in May 2013 is a sort of spectacular example of that. Even the great bond rout of 1994, even the end of 2018, early 2019, when Jay Powell then was sort of saying that effectively the balance sheet reduction and was on autopilot, and the rates had further to go, etc. So that's not been the driver. What's been the driver is this re-rating, as we've discussed, in terms of growth expectations. So I think that's why, broadly speaking, risk assets have held up pretty well. I mean, credit certainly has been pretty resilient to higher rates. I mean, we've actually had spread tightening so far this year. Since rates started moving up more quickly, it's been a little bit more volatile, but not massively by any stretch of the imagination.
Actually, on the credit question, that surprised many people. Like after the pandemic, the economy shut down, yet credit in general has actually held up remarkably well. I mean, has that surprised you or not?
Yeah, look, I mean, it was, if I'd had perfect foresight, or we'd had a conversation and you'd said to me at the beginning of 2020, we're going to have the most severe economic recession and global recession in, modern history, then I would have said credit's going to be cremated because we're going to have double-digit default rates. And we haven't. And in fact, I mean, in Europe, the default rate in the European high yield market has been running at sort of less than 3%. In the US, it's been, meaningfully higher. It's sort of peaked around sort of 8-9%. But if you actually strip out energy, so, sort of high yield shale producers, then if you strip out energy, then actually in the US, the default rate's only been running at sort of 5-6%. This is really extraordinarily low given the severity of the recession.
Just for context, where were the default rates after the global financial crisis in 2008?
So, for example, in US high yield, it peaked at around about 15-16%.
Okay, so we're much lower than what we saw in the kind of last crisis.
Yeah, kind of, pretty much double. And, again, much higher also within Europe as well. Emerging market corporate defaults, I mean, we've seen some sovereign defaults, but corporate defaults have also been extraordinarily low. And that's been part of this policy response. And it's actually been more on the fiscal side than I would argue, than the monetary policy side. Businesses have been supported. I mean, a huge amount of operational expense has been taken on to the government's balance sheet through short-time working and furlough schemes. We've seen tax and rent holidays. So, and also we've seen actually direct bailouts as well. I mean, we've actually seen governments directly come in and provide direct financial support. We've seen, and another big difference about this crisis, certainly compared to the global financial crisis, is where obviously banks were very much at the center of that particular crisis. In this crisis, they've been, because they're much more resilient, and they've been used by policy authorities to provide support to the broader economy. So things like guarantees on bank lending to small and medium-sized businesses has been very important. And then you've had things like the ECB, but also the Fed's intervention in credit markets, which in terms of money spent was tiny. It was tiny. It was very little. But what it did was ensure that credit markets stayed open. And again, if you look at typical economic downturns, even setting aside the global financial crisis, but even typical sort of economic downturns, then access to credit gets much tighter, and only really the best, the higher rated companies, the bigger companies can continue to access public credit markets and get new financing from banks. This time in 2020, we actually had a record volume of issuance in the US investment grade and US high yield markets. Public credit markets were very much open, willing and able to provide the liquidity to support the economy and the businesses through this downturn. So that's kept, ultimately you restructure or you default because you run out of cash. So, we didn't have that liquidity squeeze or catalyst.
I mean, do you think when the government support runs out, presumably it will end at some point over 2021, that will be the sensitive point for the default cycle? Do you think at that point it will be revealed that the whole bunch of, companies can't survive?
Yeah, I mean, that's been very much, the debate that we've been having within our sort of investment forum in BlueBay. I think they're pretty well flagged, though, within the market right now. So I don't think there's going to be sort of any big surprises. I think where you could get a bigger pickup in defaults going into the end of this year and into next is actually if we don't actually get a full return to normality. So, the expectation that we will get a full reopening is allowing, airlines and cruise liners and car rental companies and travel companies to continue to get funds, whether it be from private equity, public equity markets, obviously tap public credit markets, because, we as investors are saying, yeah, I can see the other side and I'm willing to bridge you to that other side. And okay, you're going to be much more leveraged and you're hence why you're paying much higher yields. But hey, we can work together through this and see the other end. But if that sort of other side shifts 6 months or 12 months, or actually whatever is on the other side, it's not the getting on a plane on a regular basis, whether for business or for pleasure, then actually we're going to see a big pickup in restructuring and defaults and business failures in those sectors. And I do also think there is perhaps some underlying sort of distressed credit that's being sort of disguised, if you like, particularly in private markets. There's a lot of private capital around. I think a lot of that has put additional money in to support businesses, but it gives them the optionality, if you like. They don't need to restructure, or they have done some restructuring in terms of extending the liabilities and payment profile, and changing business plans. But it doesn't really, it's not counted as a default, but it's kind of in distress.
Yeah. And if you do have that uncertainty about that handoff or that bridge to the other side, so to speak, I mean, is there a way you kind of hedge your portfolio for that possibility? Or do you kind of keep your portfolio tilted towards kind of the reflation risk trade and you'll adjust the risk as you get more clarity on the scenario?
Yeah, I mean, it's one of those, that sort of real downside risk, which is, if you like, either could come about, heaven forbid, because there's a variant of COVID-19 that renders existing vaccines much less effective, or for whatever reason, the vaccine rollout is not complete and or there's changes in behavior. There's various things that could happen. It's hard to construct a sort of portfolio that kind of gives you the upside to the full reopening and full recovery, but at the same time you're kind of hedged against that. So really the way that you try to manage that is really the quantum of risk that you're taking on that sort of reopening and sort of COVID recovery plays within portfolios. So, we've done that we do have that trade on in our portfolios, but it's been skewed towards areas where we think we have more confidence that there will be a return. So, gaming, we do think people are going to go back to casinos in Las Vegas, short haul flights in Europe, for example. But, there's some other, sectors, cruise liners, or where that could still be a great trade, but it's one where, we don't have as high a level of conviction. So it's about, the quantum of risk and, picking the spots where you want to have that exposure. I mean, the biggest sort of headwind to credit so far has actually not been from concerns or worries around, reopening and recovery and whether that will happen and prove durable. It's actually been obviously the headwind that's coming from higher rates. So it's really been more about kind of managing your sort of DVO1 risk, if you like, rather than getting over your skis in terms of credit risk.
Yeah. And, you've mentioned a few sectors so far, but, what about the energy sector?
Yeah. So, I mean, the energy sector, as I say, was one of the hardest hit last year. Kind of classically, it's a cyclical sector. It's a sort of high beta to global growth. Obviously, we've seen a meaningful recovery in commodity prices and in oil prices. So a lot of that recovery in related credits has played out. It's also been a difficult sector to invest in because you've got that kind of, part of the value added that we bring as active investors or active managers is, going through the individual balance sheets, looking at the cash flows, looking at the capital structure of the business and the business model. And then you have this great big, kind of hard to predict macro price, which is the oil price, sort of lying over the top. So, we've had an overweight in energy exposure. We're pretty flat now. We do have energy exposure meaningfully in, for example, in some of our emerging market strategies. But that's a kind of often the big energy producers in emerging markets are basically sort of parastatals, they're quasi sovereigns. So it's you're kind of mixing some of the sovereign risk, if you like, with some of that kind of commodity risk.
Yeah. And then on the emerging market side, the story's been a bit mixed this year. Obviously, recently we had the Turkey news around the change of the central bank governor. Then in Brazil, there's kind of ongoing concerns about the fiscal picture there. There's the political side is also sort of changing, with Lula possibly returning to the political arena. How are you looking at the big EM regions?
Yeah, I mean, it is a mixed picture for, undoubtedly. I mean, broadly speaking, we're, generally positive on emerging markets as part of that sort of global recovery theme. Manufacturing is doing well. Global trade is picking up. Commodity prices are higher. I think, one way, that people have, colleagues to me have kind of described it has been, well, yeah, sort of emerging market growth is kind of set by policy in Beijing. Emerging market financial conditions are set by policymakers in Washington. And, so far, Beijing and China growth has been very strong and seen big pickup in demand, and obviously has been reflected in commodity prices. That, I think, as you alluded to earlier, that we could get an inflection point there. I think people don't perhaps give enough attention to China and its kind of cycles and how that impacts the global economy. But at the moment, it's still pretty strong. And so what's been sort of impacting on emerging markets has been policy being set in Washington and the rise in treasury yields. Now, external financing, dollar financing needs of emerging markets today are much, much lower than certainly in sort of 2013 when you had the so-called fragile five, being exposed with big current account deficits. But, when you have an environment where US Treasury yields are moving higher, you've got some bid into the US dollar, then that does start to expose some of the, if you like, some of the weak links. And we're seeing that kind of play out. So we are seeing idiosyncratic stories which have been there and with idiosyncratic sort of weaknesses, but then being exposed and brought to a head, if you like, by this sort of macro shift that we're seeing, this change, this re-rating of US rates. I still think, I think, emerging market credit, particularly corporate credit, has proved very resilient. I think the fundamentals are pretty good. And I don't think it's going to meaningfully underperform developed market credit. It may not necessarily outperform, but I think it's going to, do reasonably well. I think on the sovereign credit side, there's a lot more differentiated story, which gives you some opportunities on the short side and in terms of sort of like playing sort of kind of distressed debt situations, as well as being long on the positive side.
Are there certain markets, countries you're looking at on that side, on the sort of the long and the short side?
Yeah, so countries where we do like the broad story and current valuations would be, Mexico will clearly, be a beneficiary of the US economic recovery, is relatively fiscally conservative, very credible central bank. So it has lots of issues and structural issues, but it's a good sort of backdrop. So, we like Mexican sovereign and corporate credit. There's also other countries in Latin America like Peru and Colombia, which we think will do reasonably well. Obviously, Brazil, Argentina, they're very, very different. I shouldn't really put the two together in that way, but there can be opportunities, as I say, even in a distressed credit like Argentina and, other countries that we like from a sort of long perspective. I mean, we do like China, both government bonds. We like China, sort of tier one property developers. We like some of the sovereign and corporate credit, for example, in Indonesia. So, there's places where you can go and where I think the growth outlook is strong and, the underlying sort of macro fundamentals are such that they will benefit from be able to capture some of the benefits from this broader global recovery. But as we saw with the announcement in Turkey of the change in the central bank governor, those who have sort of idiosyncratic weaknesses will be exposed and there won't be anywhere to hide.
Yeah. And one of the things that I find when I speak to investors increasingly is the whole ESG agenda. It really does feel like it's become really mainstream, such that it's not just a side consideration now. It's like a central consideration for lots of asset managers. Yeah, it really has changed over the past year, I'd say. I mean, are you finding that as well? And what do you think are the, just the implications for the industry of this?
Yeah, I mean, you're absolutely right to, say that sort of change and the importance of, ESG, environmental social governance factors and sustainable investment more broadly as an industry. We have to respond to what our end investors are wanting. And is particularly in Europe, US investors, I think, have been lagging in terms of their understanding, appreciation, desire for having ESG integrated investment strategies or an ESG tilted strategies and ultimately, impact investing, etc. But I think even now, potentially with the change in the US administration that we'll see, I think, US investors catching up to that. Certainly, I think in Europe and Asia, and not just amongst investors, but regulators, central banks. I mean, it was a bit of a, not minor, but it was a sort of small thing in the UK budget announcement recently. But actually, there was an amendment to the sort of supplementary objective or secondary objective of the Monetary Policy Committee of the Bank of England, which is to support the government's efforts to transition the UK economy to net zero carbon by 2050. So it's filtering through. So what's interesting, I think, is that it's moving from ESG integration, and investors and asset owners want to see that you are in a rigorous and proper manner integrating ESG into your investment process. It's not a sort of separate or an add-on or a tick box exercise. It's properly fundamentally integrated. And then I think moving beyond that, looking to go beyond sort of negative screening. So, okay, you don't have, tobacco companies or producers of weapons or whatever in your portfolios, to actually having a positive impact and being able to demonstrate that in terms of the investment allocation and having a positive impact in terms of outcomes. And some of that is obviously through, straight impact investing and supporting projects in clean energy, but that's also about, engaging with the business or engaging with policymakers if you're a sovereign debt investor, and talking to those policymakers about deforestation, and that is actually something which does impact the investment allocation and ultimately is going to have an impact on your access to and cost of financing. It's going to be huge. I think it is the big secular trend for the asset management industry over the next decade.
Yeah, no, I agree as well. And yeah, I imagine there's going to be lots of changes that we haven't even seen yet. Yeah, so it's definitely a space to watch. So that was great, kind of talking about markets, but I also do like to talk to my guests about or personal questions. So a topic close to my heart is, how do you manage your information and your research sort of inputs? It's quite easy to be overwhelmed, with emails and just Twitter and social media and all, just other reports that you may receive. How do you manage your information flow?
Yeah, probably not as well as I should do, is the honest answer. And it's a good question. It is a challenge. I mean, the danger always is that you try to assimilate so much information that ultimately you can't kind of, as you say, you can't process it into intelligence and ultimately, from my perspective, into actionable investment ideas. So in some respects, I don't want to sound sort of anti-expert, but don't over-analyze. If you can't kind of reduce down your investment thesis to a sort of narrative that you can explain to an intelligent, but if you like, casual observer, then it's probably too complex and it probably has too many moving parts from an investment perspective. When it comes to, if you like, maintenance research, I try to just narrow that down. There's just one or two, morning emails that I'll read, and keep it narrow in terms of where you think are a couple of kind of key reliable sources of information on issues like tracking vaccine rollouts, and on the macro analysis and forecasts. I mean, there's so much macro analysis out there. I tend to actually rely much more, if you like, on source. So I'll read working papers from produced by the Fed, or read the economic bulletin by the ECB. The the speeches by monetary policy makers or finance ministers. Yeah, I mean, I think if you go to the source, you can cut out quite a lot of the noise and also get your kind of more unfiltered view. And then finally, I would just say, talk to people. I mean, I spend a lot of time, probably more time than my colleagues would like, but I spend a lot of time talking to my colleagues, who are specialists in European high yield market, who are investing in leveraged loans or emerging market local rates. And that's a really efficient way for someone like me who's looking from a broader sort of cross-asset perspective. It's a really efficient way to kind of filter and focus on the key issues which are relevant from an investment perspective.
Yeah, no, that certainly makes a lot of sense. And, perhaps a related question is books. I'm a big fan of books, reading books. Are there any sort of books that have really influenced you over your career, or are there some books you've read recently that have been really good?
I mean, yeah, reading and being eclectic in the way that you think about the world, I think is really important in our industry. So I think that makes reading very much. I mean, in terms of things, Fooled by Randomness by Nassim Taleb, was one of the sort of books which I read, which, did make me kind of think about, more carefully about, things about the sort of classic errors of induction, around black swan events, also just, about survivorship bias. Actually, sometimes people like me, I'm sure he would, describe me as at times talking head on financial TV, where we're always looking to put a kind of narrative on a 1% move in Euro stocks, when that's a random walk. I think for kind of rigorous kind of thinking about how to think about thinking, Daniel Cannon's book Thinking Fast and Slow was had a big impact in the way that at least I tried to kind of discipline myself, if you like, and it's really interesting, I think, from an economic perspective, because it kind of challenges the sort of economic textbook view of rational agents. Doesn't mean people are behaving irrationally. It's understanding the kind of biases which we all have. And I guess more recently, Trade Wars Are Class Wars, I've just finished reading by Michael Peretz and Matthew Klein, which I really, I enjoyed. I didn't wholly share all the views, but I did being expressed in it. But it was an interesting read.
Yeah, I had Michael as a guest last year where we talked about the book. Yeah, it was a really interesting kind of thesis he had. He's definitely very provocative.
Yeah, and it's one where it kind of chimes to some extent with, I thought, with some of the views which you even had in the kind of populist sort of Trump administration. They probably wouldn't want me to say that, perhaps, but Michael Peretz, but I don't think that's his leanings. But, in the sense, though, of how the policies have been enacted and these big sort of excess savings and big surpluses in Germany, which, as a result of the way that they responded to the Eurozone crisis, was a policy stance that got kind of imposed, if you like, or a business model or an economic model got imposed across the whole of the Eurozone. And of course, China as well, with its big excess savings and surplus, kind of created the sources of inequality and sort of dysfunction in the global financial system, which is, if you like, fueled some of the kind of populism and, the trade wars that we've subsequently seen. So, as I say, I don't actually share all of the kind of analysis, but it's exactly the sort of thing which I like reading, because it kind of challenges some of my views and it gives an alternative perspective. So, and people like, Richard Koo on balance sheet, the nature of sort of balance sheet recessions, I thought has been really interesting. Always interesting to read stuff about Japan.
Yeah, no, that's true. Yeah. Japan's one where like everything you think that should happen doesn't happen, and it's always the corner solution or the case that doesn't ever kind of follow what you think should happen. But that's great. Now, if people wanted to follow your thinking and your work, what's the best way for them to do that?
I do a podcast every couple of weeks, which is available from all good podcast platforms. And also, it's freely available from the BlueBay Asset Management website, and do put out sort of occasional sort of insight pieces. I'm not as prolific as I probably should be, because I just spend a lot of time working with colleagues on our sort of internal investment ideas and analysis. But probably the podcast is probably the best source of commentary from me, at least.
Yeah, no, that's great. Well, with that, thanks a lot. It was a great conversation. I learned a lot. Hopefully our listeners did as well. And yeah, good luck with trading these markets.
Yeah, no, thanks very much. I really enjoyed it. And thanks for the invitation and this opportunity to have this kind of discussion. It was fun.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating and a nice comment. Let other people know about the show. We'd be really grateful. Also, sign up to become a member of Macro Hive at macrohive.com. We'll be back soon, so tune in then.